My name is Alex Flournoy, and I head up the product specialist team at Omega Point. And Omega Point provides a platform for institutional asset managers to be able to access kind of sophisticated tooling and data that can help them incorporate quantitative processes into their workflows. And this is extremely important in the current markets, which we know are becoming kind of increasingly factor driven in nature. And I know that factors are one of the things that we plan to talk about today. So what is a factor exposure, or what are factor risk models? Well, really, before we can answer that question, we should kind of level set on what factor models actually help us understand. And typically that's risk. So a better question to start with might be, what is risk? And the way that we think about it is that risk is really just kind of uncertainty. And people quantify this in many different ways. Some people use metrics like value at risk or VAR. Some people think about it more simplistically, like gross or net dollar exposure to the market. But in the context of factor models, and in particular equity factor models, typically we're talking about the expected volatility of an asset or portfolio. So in other words, how much could we expect the value of that portfolio or the value of an asset to potentially fluctuate over time. So once you've actually quantified how much it could deviate, the next thing is to consider why it could deviate. And this is actually, in many cases, a more important question, is kind of what sort of external forces could come into play that could push an asset or a portfolio in a way that's different from what you expect. And so we use factors to describe the movement of stocks, assets, portfolios. And a factor is really just a characteristic that's kind of common across a group of securities or a broad market. Probably the most well-known factor would be something like beta. It's widely accepted that the way that a stock has moved historically relative to a broad market like S&P 500 or the MSCI ACWI is typically a good indication of how it could be expected to move in the future. But research has also shown that there are lots of other factors that exist besides just beta that explain the movement of stocks. So these could be things like size or market cap, where we know large cap stocks tend to perform very differently than small cap stocks, or value, where we know cheap stocks perform very differently than expensive stocks. And what we've seen is that kind of like as the sophistication of financial data collection and tooling and methods to actually analyze all of that data has grown and increased over time, models are starting more and more to incorporate different types of factors, kind of more alternative, non-traditional types of factors. Things like long and short active crowding, or crowding coming from ETF flows, or maybe sensitivity to rates. And as you can imagine, these are the types of factors that are very relevant for the current market environment. So now that we've kind of defined risk, back to the original question of what is a factor exposure, like I mentioned, it's really just like a characteristic with regards to those factors. So if I have a $10 million position in a stock, how much would I expect that stock to change due to its market cap or its multiples or maybe its sensitivity to rates? I do think, based on like the many conversations that I have with fundamental or activist stock pickers, most of them say, why should I care about factors? What they prefer to do is just focus on kind of their deep fundamental research, think about the idiosyncratic nature of stocks. What is the management quality of the company, what's the IP of the company, and so on and so forth. But the reality is that there are many kind of external forces that push these stocks around and kind of create sort of price action that has absolutely nothing to do with the fundamentals. Actually, there was a report that came out from JPMorgan in 2017 that noted that only 10% of stock flows were actually attributable to fundamental stock picking. So that means that conversely, 90% of those flows were quantitative or factor-based in nature. So as you can imagine, if 90% of the flows on stocks are factor-based in nature, then there's really strong external forces that are completely unrelated to the alpha thesis on a name. So as a fundamental investor, especially as a short seller, it's really important to understand kind of what those external forces are. Most market environments have the potential to see very large factor concentrations. And of course, this happens to kind of varying degrees over time, but really anytime there are these underlying kind of themes that can bubble up to the surface that are driving kind of the market or segments of the market, you're going to start to see an increase in the prevalence of not just factor concentrations, but unexpected factor concentrations, which is really the key. The factors that you didn't know existed in your portfolio or that you preferred to avoid, but maybe unintentionally ended up leaning into. We also see factors become crowded when there are regime changes or style rotations taking place, much like what we're experiencing now, kind of with the shift to a more macro-driven environment, the value and growth rotation that's occurring. And during these times, the market often kind of struggles to adjust quickly enough to really kind of mitigate risk coming from these regime changes. So yeah, so how often do kind of new factors come into play, or factors sort of change or evolve over time? I mean, there's two ways to really think about this. The first is that, there may be factors that have existed for quite some time that maybe we didn't have sort of the methods or the sophistication to actually be able to quantify or capture. So as I kind of mentioned earlier, the improvements in technology, improvements in data collection and analytics really allow us to start to kind of discover or find factors that may have existed for quite some time, but like I said, that we didn't really have the ability to actually capture. So there's that aspect of it. And then there's also the aspect of just the changing market dynamics. So as I mentioned earlier, right now the rising rate environment is, a really relevant risk that managers are really thinking about. And it's something that maybe 3 years ago or so, wasn't quite as prevalent or wasn't quite as sort of market moving in nature. So, new factors are kind of always evolving and coming out of the fact that the markets are very dynamic and they're kind of always changing. So short sellers don't necessarily accumulate more or different factor exposures than long investors. The stocks that they're investing in are subject to the same types of systematic pressures that long investors experience. But one difference I would highlight is that the pain that short sellers feel from a factor rotation or when a factor moves against them tends to be more acute. So it's faster and it's sharper than what a long investor might feel, and especially when that factor move is widespread. And really the reason for this is that the liquidity characteristics for highly crowded shorts are quite different than that of highly crowded longs. Short sellers tend to feel pressure to cover their losses sooner in order to be able to avoid kind of large losses or a squeeze. An example of this, we can think back to Q4 of 2020 when COVID vaccine news first came out. I think it was maybe early November of 2020. And the market started to very rapidly price in an economic recovery. That really caused factors to do some strange things. Momentum very suddenly crashed, experienced like a 5 standard deviation downturn. And then beta subsequently had this really rapid rally over about a month's period. Beta had actually already been rallying for the majority of 2020, but it saw a very kind of sharp upturn around that time. And this put very rapid upward price pressure on crowded shorts, things like the Bed Bath & Beyonds of the world, Blackberries, GameStops, which all had a very kind of strong overexposure to beta during that time. And so this type of rapid factor movement likely made it very challenging for those short sellers who may have felt pressure to cover their losses kind of quickly to mitigate those losses, but likely struggled to find the liquidity to do so. Hedging the factor exposures for short sellers, but really any fundamental or kind of activist stock picker is extremely important because there's likely somebody else on the other side kind of evaluating their skill that's sort of making sure that that skill really is in identifying sort of the idiosyncratic nature of those bets, doing the deep fundamental research that's required to kind of understand what's going to move the company for company-specific reasons, not for more systematic reasons. Because of course, their clients can go out and get that systematic exposure very cheaply in the market. So I think it's extremely important for fundamental managers and short sellers to sort of not only be aware of what systematic or factor-driven risks exist in their bets, but also to take steps to actually hedge out those factor exposures so that they really are kind of focusing on the idiosyncratic nature of their bets. Well, the first step in sort of hedging out your factor exposures without kind of removing or neutralizing your alpha thesis, your alpha bet, is first and foremost to understand what those factor exposures actually are. And once you understand what those factor exposures are, then the most effective way to neutralize those factor exposures would be to kind of build an offsetting hedge that exactly aligns with the exposures of the stock that you want to remove. So for example, let's take a very highly shorted stock like AVIS, for example. AVIS currently has positive sensitivity to interest rates. And that means that as we kind of continue into the rising rate environment, we would expect AVIS's exposure to rates to sort of be a tailwind or would result in positive performance for AVIS. But that means that if you take a short position in AVIS, that's likely going to result in a net negative exposure to rates. So given the current rising rate environment, that's a very risky exposure for one to carry. So typically what an investor would do is find a basket of stocks to take a long position in that has positive exposure to rates. So for example, if you're $10 billion short AVIS, you would want to go long $10 million of this basket, which is going to do two things. First, it's going to mitigate your market exposure because now you're kind of running a net neutral trade. But secondly, it's going to mitigate your rates exposure specifically because you've completely offset that exposure that AVIS had using the long basket. Now, in practice, there are a lot more risks to mitigate than just interest rate sensitivity. So a more precise approach might be to actually optimize that long basket of stocks against AVIS in such a way that minimizes all of the factor risks and conversely maximizes the idiosyncratic behavior of the combined trade of AVIS and the basket. As you can imagine, that's definitely not something that's kind of effectively done by hand or easy to do with like mental math in your mind. So at Omega Point, we actually have optimization tools that do this programmatically. And this allows investors to really focus more on that deep alpha research, which is where their skill is at, and also have kind of access to easy methods for risk mitigation. First off, what leads to a short squeeze and why do short sellers care about it? Well, if I'm a short seller, I have some kind of a fundamental belief that a company's sort of fundamentals are going to deteriorate over time, or perhaps I'm using an investment or a position in a name as a hedge for my long book. In either case, what I'm looking for is the price of that asset that I have a short position in to decline over time. So what happens is when there is sort of unexpected positive price action on that name, especially when it's unrelated to the fundamentals of that name, then I might be forced to kind of buy back the stock in order to cover my short position if my losses become too great. And that buying action, especially when it happens across many short sellers, and this is where crowding comes into play, kind of ironically continues to influence the price upwards. And then as the price continues upwards, where this unexpected price action is occurring, you start to see other buyers start coming into the market that may not specifically be short sellers. So now you're working against the short sellers. You're also working against long investors who are trying to take advantage of this positive price action. And you get into this loop where short sellers start to cover their losses. That price moves the price up. Then additional buyers start getting attracted to the market. That further pushes the price up. Now more short sellers are getting what's called squeezed out of their positions because they continually need to kind of cover their losses. And you can kind of see how this forms a nasty cycle for the short sellers. So, the key there, as I mentioned, is kind of the crowding. When this starts to happen across many different short sellers and also across, many different long investors as well, that's where you start to get into trouble. And so it's very important for, really, again, any fundamental investor, but in particular short sellers, to be very aware of kind of the crowding characteristics of the names that they hold. So there's a variety of different ways that you can kind of identify crowding. So for example, if you want to understand sort of how your names are affected by institutional asset managers, you might look at things like institutional ownership coming from 13F filings, and that can kind of help identify long crowding. If you wanted to identify more short crowding, you might look at like the level of short interest or utilization metrics. So short interest is a percent of float. More and more, I've also started seeing people kind of trying to quantify crowding that occurs from ETF membership, which can be a really big deal, especially around kind of the index rebalance periods. And so you can look at things like ETF inflows and outflows, particularly around certain times of the year when they know that indices are coming up on the rebalances to kind of quantify crowding that occurs there. And really most major risk model providers or data providers are going to have some type of factor that captures these crowding exposures. But there's actually an additional one that I would mention, an additional dimension that we've started to look at that is really interesting. And that is a data item that comes from one of our data providers, S3 Partners. And they provide what's called a squeeze risk score. And this score is a 0 to 100 score, where a score of 100, well, really they say anything above 70, identifies a stock that is kind of at high likelihood of incurring a squeeze. And what they identify as this high likelihood is partially based off of those standard kind of short crowding metrics that I mentioned, like short interest as a percent of flow, utilization days to liquidate, or I guess days to cover for the short side. But they also are able to capture the aggregate P&L on a short trade. So in other words, they can start to capture whether or not short sellers in aggregate are in the money or out of the money. And that's important because short sellers aren't going to cover their losses when they're still in the money. They're just going to kind of sit tight and try to wait it out. But when they start to become out of the money is when they're going to feel like they need to cover their losses. And that's when the squeeze can start to occur. So what we've seen is that this squeeze risk score can actually function as kind of an early warning sign, where you can, ideally predict kind of ahead of time or as the squeeze starts that it's going to occur. We saw an example of this with the AVIS short squeeze that happened in, I think it was early November of 2021, where the squeeze risk score started to escalate, past that threshold of 70 and actually went all the way up to 100 around late September 2021, which was several weeks before the short squeeze itself actually occurred. So we saw this kind of elevated level of squeeze risk, and it wasn't only elevated, but it persisted for several weeks through the short squeeze itself. And so this was kind of, like I said, an early warning sign, an early indication that the market dynamics for AVIS were changing. When we think about factors, there's a variety of different dimensions and kind of ways that you can sort of slice and dice them. Sometimes it's important to look at just the pure level of the factor characteristic. Sometimes it's important to look at the rate of change of the factor characteristic. But most often, what's really important to look at is the level or the rate of change of the stock relative to all other investable stocks that you see, right? Because everything is sort of a trade-off in terms of, investing in one name versus another. And it's important to understand how the characteristics or the factor behaviors change for a stock relative to another one. And so we kind of think about them, across all of those different dimensions. Like I said, level, the rate of change, like how rapidly is the characteristic changing, either increasing or decreasing, and then also what it all looks like relative to its peers. The current market environment is just so clearly factor driven, right? And it has been for some time. But I think what we're starting to see is that, asset managers, hedge fund, banks, really large institutions are starting to feel kind of the pain from being unable to very effectively and quickly kind of quantify their factor exposures, and not only quantify them, but take action on them as well. And I think that is kind of fueling a trend that we're seeing is, these teams that are traditionally, standoffish as it comes to factors are starting to kind of open their eyes to the idea that, they need to be very factor aware. And not only factor aware, but they need to have tools that allow them to actually mitigate those unwanted factor exposures that we discussed earlier. Right now, in particular, I think the things that are really top of mind for investors are the macro-driven environment. So people really need to be able to very precisely quantify what their interest rate exposure is or what their exposure to inflation is. And then be able to kind of find and source new ideas. So kind of leverage very robust research prioritization and screening tools to be able to understand, okay, well, where can I find names that can help me mitigate that interest rate risk exposure, but still stay within my mandate? So that's certainly one trend that we're seeing. Another trend that we're seeing is sort of, how can I mitigate my exposure or mitigate my risk around the value versus growth rotation? Growth managers right now that historically, were running very heavy bets against value are starting to feel that pain right now. And I think part of the education process that we have is that it doesn't necessarily need to be an either or situation. You can still be a growth manager and kind of lean into, high quality, high growth names, but also find names that fit into that mandate and can also help mitigate your risk against value rotation, whether it's finding long ideas that are growth oriented, but also have some value tilt, or if it's finding short ideas that can kind of help kind of offset or mitigate that value exposure. You can definitely use factor exposures to offset one another and actually kind of have two factors that are a trade-off to one another that can help mitigate your risk. And that's part of the concept behind a risk model itself. We talked about the factor exposures that drive risk models, but the other thing that drives risk models is this notion of a correlation matrix or covariance matrix. So understanding how one factor is going to move if a different factor moves in a certain direction. And this covariance matrix or this, the correlations that underlie the risk model can kind of very easily quantify and capture all of that in a very systematic way. So there's two ways, kind of two high level frameworks, I would say, that I think about when I think about sort of factor offsetting and risk mitigation. So, we talked earlier about, how you would go about actually hedging your factor exposure, and how part of that is using an optimization process to be able to kind of mitigate or minimize risks across all factors at one time. And an optimizer typically will leverage a correlation matrix. So, be able to kind of see how the factors move in relation to one another to be able to kind of minimize all of those risks. So you might even be willing to take a little bit of a larger bet in one factor because, that large bet in a factor is going to completely offset a bet in a different factor, and then that can kind of help mitigate your risk. But then the other framework that I would think about is that, these factors, particularly, kind of the more fundamental or style factors, are not mutually exclusive. So as I mentioned earlier, just because you are a growth manager, you typically have, overexposures to growth type of factors, doesn't necessarily mean that you have to have an underexposure to something like value, or an underexposure to, a different type of a factor. And so again, you can kind of use screening tools to say, well, I want to find names that are in my investable growth universe, for example, that also have overexposure to dividend yield or overexposure to earnings yield or to book to price, to be able to kind of find those names that sort of fit in both camps and can be good names to lean into as you're going through rotations like the one that we're experiencing now with value versus growth. As we've talked about, throughout the conversation, the market is becoming increasingly factor driven. Factors are certainly here to stay. And it's super important for asset managers, hedge funds, banks, large financial institutions, all the way down to small financial institutions to really have access to the tools and the analytics that exist out there to be able to appropriately manage risk on their portfolios. We like to think about this as kind of quant enabling your investment process. And, it requires sophisticated tooling, it requires scalable tooling, and it also requires kind of expertise, which, Omega Point kind of offers a platform for institutional investors to be able to access in a very kind of turnkey manner.